So although how much we save is always going to be significantly more impactful to whether or not we accomplish our retirement goals, how we invest that money has always been the more complicated part of the process for most folks. And not because it is more complicated, but just because for most people it is not something they're comfortable or familiar with. Now don't get me wrong, how we invest our money is very important. If we don't invest correctly, then we're going to have to save a lot more than that 10 to 15% recommended savings rate in order to get to the same outcome. So the goal of this video is to help demystify and uncomplicate the decision of how we invest our retirement savings. Now, investing for retirement during the majority of your career, and we'll call those your savings years, is much less complex than many make it out to be. Now, whether you have $5,000 saved or $500,000 saved for retirement, the fundamentals of investing over the long term for retirement remain the same. There's no secret sauce. It is not rocket science, so don't overthink or overcomplicate the process. There are generally accepted investing principles over the long term that we should all follow. And those are two main things. One is diversify your investments, and the other is be aggressive when you're young and get more conservative as you get older. Now, you've probably heard of both of those things before, but let's dig into them a little bit further. So when we talk about diversifying your investments, what we really mean is to own a little bit of a lot of things. When we invest for the long term, what we don't want to do is start trying to make bets on what might be the best investment from year to year in the short term. Rather, we just want to own many different pieces of the market so that we don't have to make those bets year to year. We want to own big companies and small companies, US companies, international companies, so on and so forth. It's also important to not try to attempt to time the market and when it may be up or down. That is also extremely difficult to predict over the long term, and if you get that timing wrong, you run the risk of being out of the market during some of the best positive days that it has, and that can significantly hinder your long-term performance. So by diversifying correctly, you can participate in the long-term performance of the global markets without having to significantly expose yourself to the risks that are unnecessary for long-term investing. Now, the other long-term investing principle is being aggressive when you're young and getting more conservative as you get older. Now, what that really means is play more offense, own more stock, focus on growth in your younger years, and then as you start approaching retirement, own less stock and own more defensive investments like bonds and cash so that you can begin preserving a portion of what you've saved. Now, when we're younger and we're focused on growth, we need to be able to expect large swings, volatile markets, highs and lows. It's all part of that long-term ride. But as we get closer to the part of life where we're going to need to rely on these savings for retirement income, it's important to ensure that a decent portion of our portfolio is no longer subject to those large swings, because we'll need some of that money in the short term and it might not have the time to recover. So once you know the principles of long-term investing, then it just becomes a matter of putting them into action using the options that you have available to you in your retirement plan. Now, back in the day, that meant going through this laundry list of investments that you may not have understood and pretending like you knew what you were doing to make your own portfolio. Fortunately, the industry has realized that is not a great idea for most people. And so in today's retirement plans, you're going to find professionally designed options such as age-based target date funds or risk-based asset allocation models. Now, these types of options can greatly simplify the process of investing while still following investment fundamentals. Don't ever feel like you have to make your own portfolio. It just is not necessary unless you have a very unique financial situation. Talk to our team or another financial advisor. Get the help that you need and confirm what's good for you, but give serious consideration to these types of do-it-for-me options. They were designed specifically to help you make better financial decisions and help you accomplish your retirement goals. So regardless of how you decide to invest your retirement savings, remember, don't overthink it, don't overcomplicate it. Don't bet on things, don't try to time the market, don't chase the winners. Don't feel obligated to make your own portfolio. Just stick to the fundamentals. So I hope you enjoyed this video. Be sure to check out our next video, which is where we're going to discuss how your investment strategy should change as you start transitioning to your retirement years, because that is a whole different approach. Until then, check out our YouTube channel for other helpful videos that we've made. I hope you all are doing well. Take care. We'll talk to you soon.